Hi, my name is James Robinson. I run an investment company called Robinson Stocks. I manage about $4 million for 35 investors. I've been doing it since January of 2023. In that time, I'm up about 40%, up about 25% for the last year, actually 28% for the last 12 months. Times have been very good. I'm, however, becoming very concerned that the market is overbought, that things are too high, and that the market is more likely to go down in the next 12 months than to go up. And so as a result of that, I'm making this video. I've decided that I will stop taking new investors and I will stop taking new money until such time as I feel better about the market. I'm also going to be dramatically changing the makeup of our portfolio and dramatically increasing cash and reducing our positions. Prior to doing that, I wanted to give an explanation as to what I'm doing so that my investors will be aware of where my concerns are. So this video is really to talk about that. I've come to the conclusion the market's overbought and that it's time to make changes as a result of just a gradually increasing concern about the state of the market and higher and higher anxiety as to where things are. I'm going to talk to you about 8 different factors that have led me to this decision. The first one is the S&P 500's high PE ratio versus historic norms. The second one is the dividend yields that are being paid by the S&P 500. The makeup of the largest companies in the S&P 500. We're going to talk about Warren Buffett, Berkshire Hathaway, and what he's doing and why that's affected my thinking. Also going to talk about what I'm seeing as I research companies. Every day I look at 2 or 3 companies, and the research that I'm seeing is becoming more and more troubling. Finally, additionally, I'm going to talk about anecdotal conversations with business owners, small business owners who I know in my personal life. Part of why I feel the way I do is just a natural risk aversion. And finally, I'm going to talk about just the gut feelings that led me to these considerations, to these conclusions. A lot of what I'm going to talk about today and a lot of my analysis is going to go around a concept of PE ratio. And so I want to explain what PE ratio is, why it's important, and why it's bearing so heavily on my thinking. So PE ratio is a measure of the company's market value divided by the company's earnings. Looked at very simply, the PE ratio tells you how many dollars you have to invest for every dollar of earnings that a company makes. So for example, if the whole company was worth $1 billion and the company earned $100 million in income, then it would have a PE ratio of 10. Again, that's $1 billion divided by $100 million. PE ratios tend to be higher in companies that are growing earnings, and the faster they're growing their earnings, the higher the PE ratio. Similarly, if companies felt that they were reducing earnings or were in financial trouble, the PE ratios would start to collapse. But one of the things to recognize is that PE ratios are a byproduct of what's happening in the marketplace. They're not often the cause. An example is, a company like Eli Lilly, which is a very solid company, but the stock has been going up and up and up. Momentum gets involved, people get greedy, they keep buying the stock almost without consideration as to what the earnings are. Eli Lilly trades at 111 times earnings right now, which is very, very high and I think unsupportable and unsustainable in the long run. So what happens is as the market gets more and more exuberant, PE ratios increase and increase, and they start to do so without real consideration for the likely long-term growth of the company. And so the other thing that's great about PEs is it allows us to compare to separate businesses and allows us to compare historic norms. It doesn't do any good for me to tell you that, Mercedes trades at $16 a share if you don't have any context of what that means. If I tell you that Mercedes trades at 4 times earnings and that Tesla trades at 80 times earnings and they're in the same industry, that would give you a sense that something doesn't seem to make sense there. One of those 2 stocks or both of those 2 stocks would seem to be misvalued. So again, we get to normalize these earnings and we get to compare them historically to other time periods by looking at PE ratios for the companies. So let's utilize the tool of the PE ratio and look at the market in a historical context. The PE ratio today for the S&P 500 is 29.13. To put that in context, the historic PE ratio for the S&P 500, the median, is 17.4, and the average is about 19.4. So what we have is that the average company today you have to spend $30 for every dollar of earnings that you get for those companies. Historically, you would spend about $18 for every dollar of earnings. So it's gone up about 55%. It's about 155% rather of where historically it should be. That's not a good sign. There's no good reason to believe that the economy today justifies a stock market that is 50% more expensive than it has historically been, which is the first red flag that I have. To put these things in context, here's a chart of the S&P 500's PE ratio going back to 1930. So let's ignore the period around 2010. You can see that giant spike. At that point, the PE ratio for the market got to be very briefly about 110 times earnings. That's a complete aberration, and that should simply be ignored. That was a combination of factors. But again, you see that once it reached that point, it dramatically dropped back down. So that aberration should be ignored. But if you look closely at this chart, what you see is the market where it is today has only been this high 4 times in the history of the S&P 500. And again, that goes back to 1930 for this chart. And every time that it's been this high, it's relatively quickly dropped dramatically back down to the mean or the median of 18 or less. So I believe the market is very overpriced. I believe historically these numbers are not supportable. And this is the first piece of evidence that we have as to why we should be concerned. Obviously, there's other things. If it was just that, I might be willing to ignore it. But all of this stuff is, we're just looking at various pieces, and we piece them all together. We kind of go from, a mosaic of tiles to the picture that's being formed. But this is a very significant and a piece that I don't think should be ignored. One of the things I should talk about is I don't own very much of the S&P 500. Most of the stocks we own are, in fact, non-S&P 500 companies because I recognize that this is a concern. But what's going to happen, I believe, is the S&P 500 is overpriced and is going to dramatically change. When it does, people are going to panic. They're going to pull the money out of the market, and the babies are going to get thrown out with the bathwater. And even if we have a really good stock, it's going to be negatively affected. Now, we won't drop as much. We'll come back faster, the good stocks, but that doesn't mean they won't drop. And it doesn't mean it won't take some time for that bottom to get reached. And the bottom is very likely not going to be 17 or 18 times earnings. The market is going to overcorrect. It almost always does. And so all of a sudden, a market today that's at 29 times earnings could easily be 15 times earnings, which would be a 50% reduction. And you're going to say, well, that's really high. How could that possibly happen? I'd ask you to go back and look at the market in 2008 or 9, before the financial crisis. That market was at 26 times earnings. That market dropped 50%. And it was 11 years before the market got back up to the values that it was at its peak. So these things can happen in the marketplace, and this is my concern. The next thing that I want to talk about is dividend yield. So a company pays dividends. Dividends are a payout of the company's profits to the shareholders. While dividends are paid out in dollars, for example, a company might pay you a $5 dividend over the course of a year. Investors don't really look at the dividend that way. They look at it in terms of percentage of the price of the stock. You can imagine that a $5 annual dividend on a stock that you paid $100 for isn't nearly as good as a $4 annual dividend on a stock that you paid $25 for. So we look at it in terms of yield, again, to normalize things across a whole bunch of stocks. The higher the yield, the better for investors. One of the things that I think about is that a dividend is a litmus test for the health of the company. Lots of companies that are growing pay no dividend because they're investing 100% of the money back in the business. And that's perfectly reasonable. But a lot of companies pay no dividends because they don't really generate a lot of cash. And the cash that they do have, they're squandering on bad investments and bad retaining. And as a result, that company is never really generating profits for the shareholders. So I like companies that pay a dividend. I think it's a litmus test. However, we're at a position where the dividend yield is very, very low. The dividend yield for the S&P 500 is currently 1.32%. The dividend has only been less than that 2 times since 1975. That was in 1999 and in 2000, again, both around the dot-com market crash. In that crash, by the way, the NASDAQ dropped 80% and the S&P 500 dropped 50%. So what we're seeing here is, and what we're seeing is that the dividend yield is at an all-time low relative to earnings. And again, I say all-time low. It's as low as it's been since 1975, except for the 1 year, which was immediately preceding a significant market crash. And then again, you combine that with the PE ratio, which is telling us the same thing. These are sort of different sides of the same coin, but they're pointing to the same conclusion, which is this market is overpriced. Another way of looking at the health and earnings of the company is what percentage of the company's earnings are being paid back to the shareholders in terms of dividends. We call that a payout ratio. So if a company makes $100, how many of those dollars are they paying out in dividends? The current payout ratio for the S&P 500 as of the end of 2023, we won't know what the payout ratio is till 2024 because we won't know earnings and we don't know how much dividends were paid during the year. But we have complete data for 2023. The payout ratio is down to 32%. To put that in perspective, since 1975, there have only been 7 years where the payout ratio was 32% or less. And also further put that in perspective, 22 of those years, the payout ratio was north of 50. So what is that telling us? Well, what that's telling us is that companies are having these earnings, but they don't feel safe sharing those earnings with the owners. That means that it means it takes a lot more money to run your business. It means that the company's earnings are more and more suspect. It means lots of different things. But again, as a broad boilerplate approach, falling payout ratios are a sign, in my opinion, of reduced health of the corporate entity. And when you have that happening over 500 companies, and those companies are overpriced, and the dividend yield is very, very low, again, we're pointing to a market, companies which I think are more and more unhealthy relative to the price of the stocks. Another thing I want to talk about is the makeup of the S&P 500. The S&P 500 was designed to be a measure of the broader economy. It's the 500 largest companies. The idea was those companies would be broadly diverse in multiple industries. And from the S&P 500, you could glean a picture of the larger market. But the S&P 500 is not what it purports to be. It's not what it pretends to be. Most people think that those 500 companies are evenly weighted. So with 500 companies, each company has 0.2% of the value of the S&P 500. That's not the way it is at all. The 20 largest companies in the S&P, so the S&P 500 it's weighted based on market cap. So the bigger companies have a bigger share of the S&P 500. And what does that mean exactly? Well, the Apple, for example, which is the largest company in the S&P 500, is 7% of the S&P 500. I think NVIDIA and Google are about 6% each. When you add up the top 20 companies, they make up 44% of the S&P 500. So the S&P 500 is supposed to be a measure of the 500 biggest companies, but 20 of them make up half of the S&P 500. The bottom 250 companies, which is half of what we think is the S&P 500, have virtually no impact, and the bottom 100 companies have no impact at all, statistically speaking. That's not healthy. I don't think that's what was intended. But what's happened is these large companies have grown so fast and so disproportionate to the market, disproportionate to the economy, that they've just gobbled everything up. And the bigger they get, the more market cap they have, the more that trend continues. And that's going to continue until it reverses and those companies start to collapse. And so that's really a concern as we're looking at the S&P 500, that it's not in any way the 500 largest companies. It's really the 20 largest companies and a whole bunch of unimportant other constituents. The other thing that I think we should be considering is that those 20 companies, which make up 44% of the market, are tremendously overvalued. They have a PE ratio of 45.59. So we talked about that the average PE ratio for the S&P 500 historically is about 18 times earnings. We talked about that the market today is about 29 times earnings. But these 20 companies, these single individual 20 companies, have a PE ratio of 45. So they're 50% higher than the market. They're 2.5 times higher than the historical average. These companies are really, really overpriced. In addition, the dividend yield to these companies is less than 1. So again, the average yield for the S&P 500, the average dividend yield for the S&P 500 fluctuates between about 3% and 5%. These companies are less than 1. So that's less than a third of the average on the very low side. So we have tremendously high PE ratios. We have tremendously low dividend yields. We have 20 companies who are dominating the market, and they're dominating the market in a way which is artificially inflating the market in general. So we've talked about the idea that the historic PE ratio for the S&P 500 is about 18. If you think about it, if that's the average, you would expect some significant portion of these 20 companies to be below that number. The truth is only 3 of the 20 companies in the S&P 500 are below 20 times earnings. That means 17 of them are above it. That doesn't make sense. Another thing to consider, 2 of the 20 companies, so 10% of the companies, have a PE ratio higher than 100. So that's 5 or 6 times the historic average. It's not 120% or 140% of the historic average. It's 600% of the historic average. 5 of the companies have a PE ratio of north of 50, which is almost 3 times, 300% of what you would expect to find. And these are the largest companies in America. These are not, brand new businesses that are in their infancy and they're in their, exploding growth phase. These are trillion-dollar, multi-trillion-dollar companies. These are Microsoft. This is JP Morgan. This is Eli Lilly. This is Exxon and Chevron. But mostly it's these tech companies, Microsoft, Google, Tesla, NVIDIA. These companies are so overpriced, historically speaking, that it's really hard to understand how it could continue. The thing to consider is that of the 20 companies, again, you would expect this to be a broad makeup of the economy in general. That's not the way it is at all. 8 of the 20 companies are in technology, and that actually number spreads to 12 if you count pharma as a technology. And I think it's fair to say pharma is purely science, and so maybe should be considered a technology. The only technology that's generally considered technology is software and computer-driven stuff. But I think it's fair to put pharmaceutical companies as technology companies. There is not one heavy industry company in the top 100, unless you were to include Berkshire Hathaway, which has heavy industry components. But for example, there's no Boeing, there's no Caterpillar, there's no John Deere, there's no GM, there's no Ford, there's no steel making companies, there's no infrastructure, there's no heavy industry, no real businesses that make and produce things in these top 100, in these top 20 companies. There's one bank, there's 3 financial companies if you include Visa and MasterCard. But even Visa and MasterCard, for example, credit card debt is at an all-time high. How long can that continue? So what I'm trying to say is that the makeup of the S&P 500 has become unrepresentative of the economy, has become unrepresentative of what I think is a healthy makeup of the businesses. And I think it's subject to change and to normalization. If you spend any time with me, or if you watch any of my 180 videos, you'll understand that everything I do is sort of based on the teachings of Warren Buffett and Charlie Munger and Ben Graham. Warren Buffett is the greatest investor of our time. He's very, very conservative. He's very, very successful. But he's also a guy who loves stocks. He's been mostly invested in stocks most of his career. I've read every annual report for Berkshire Hathaway and the Buffett partnerships going back to 1956. I don't have the absolute study that would confirm this, but I do not remember a time when Buffett was not majority invested in stocks, with the exception of about 1969. And I'll get into that in a minute. But here's what I want you to understand. So Warren Buffett owns about 80 companies, 90 companies completely. He owns the whole company. Those are not subject to sale. He just has bought those businesses, and those examples of those are Dairy Queen and Geico and Fruit of the Loom, and you've probably heard about a lot of the different companies that he owns. But excluding that, he owns stock in about 41 public companies. The value of those public holdings is $279 billion. Now, for example, many of you knew he used to own he owns a very significant portion of Apple Computer. He owns about $80 billion of Apple Computer. He owns 10% of Bank of America, Coca-Cola. He used to own a lot of Wells Fargo. He owns a lot of very large positions in some very, very large companies. And whenever he gets a significant portion, he has to disclose that per the SEC, and so we know what he owns. and we know when he buys and when he sells because he has to report it on a quarterly basis. Today, he has $279 billion in stock. He also has $276 billion in cash. So where I'm going with this is that going back till 1956, Warren Buffett has taken his money, he's invested in companies that he thought were a good deal. He holds them for a very long period of time. Sometimes he buys the whole company. Other times he sells the stock and moves on, but he's always invested in stocks. The only time that he wasn't invested in stocks was 1969 when he closed down his partnership, eventually moving on to Berkshire Hathaway and then making that his investment vehicle. But the reason he shut down in 1969 is because he felt the market was overbought. And if you go back and look at what happened with the Nifty 50 and you compare that to today, when you go and look at what happened when he got out of stocks in 1959 or 1969 and what happened for the next 3 years when the market was totally decimated, it's fair to say that Warren Buffett's the greatest investor of our time. Warren Buffett has a good track record of getting in and understanding when it's time to get back out of the water. If he's telling us today he's 50% cash, we should be paying attention to that. We should not just ignore it. Now, I recognize one of the things is Warren Buffett has $300 billion in cash, and he can't just invest in anything. He can't buy a stake in one of our companies. For example, we own stock in a company called Marine Products. It's a $300 million company. Warren could buy the whole company, it wouldn't move the needle. And by the way, the whole company is not for sale. So he has a limited number of things to put his money in. But when he has this much cash, and it's the only time I can remember since 1956 he has this much in cash, I think that's a red flag. Another red flag is that he sold $80 billion of Apple stock in the last year. He's currently dumping Bank of America at a pretty significant rate. I just think he's trying to get as much money into cash as possible. And I think he's doing it because what I'm pointing out to you, which I think is pretty obvious, he sees as well, and he's making those adjustments. Another piece of the puzzle, and this is the puzzle that first started to get me concerned and first started to make me think about where we really were in the market, and then really start doing some research into where things really were, is just the research that I do every day in the stock market. So just to give you an understanding, I look at 2 or 3 companies every day in what I call my preliminary research phase. It takes me about 45 minutes or an hour, and I just look at companies literally in alphabetical order. And what I'm looking for are companies that, Warren Buffett says when you're choosing a basketball team, you start by looking for 7-footers, right? If the guy's 5'8", you can pass on him. It's got to be obviously a really good player, a really tall player if you're doing basketball. I'm doing the same thing. I'm just doing a preliminary search and saying, if a company's not a 7-footer, I'm not interested. But if it is a 7-footer, then I want to do more research. And so every day I look at 2 or 3 companies really looking for 7-footers. The research isn't exciting, it's boring, but I find it interesting. What I'm finding over the last 6 months is it's getting harder and harder to find companies that measure up as 7-footers. The fundamentals of the companies seem to have peaked about a year ago and are eroding in various capacities. Maybe the margins are shrinking, maybe the inventories are growing, maybe they're taking on debt, maybe they're not buying back stock as much as they used to. There's just these telltale signs as I look at company after company that they're not doing as well as they were before. Another thing that I'm finding is when I go back and I look at these companies and I look at companies that I analyzed 4 years ago and I'm looking at them again for some reason, I'm almost invariably giving these companies lower scores than I gave them 4 years ago, which means their fundamentals are eroding because I'm using the same metrics now as I did 4 years ago. So I'm finding less and less companies that make the cut. I'm finding less and less companies. I'm finding most companies are not better than they were 4 years ago when compared on an apples to apples basis. I'm also finding that more and more companies that I would like to own are just too expensive. So my first phase of my research is this company a 7-footer? My second phase of my research is it fairly or reasonably priced? And if those 2 things occur, then I go do a bunch of research on, do I really want to own this stock? And what I'm finding again is it's harder and harder to find companies that are 7-footers. And then those companies that are 7-footers, again, because the market's so overpriced, it's harder and harder to find these companies. So I'm not finding bargains, I'm not finding deals. And what I'm really finding is this market's overpriced. And it was this, boy, it's just harder and harder to find good companies that made me start to get concerned that maybe it's time to take a step back. Another step that I took as I was trying to evaluate whether or not I wanted to make this step with my portfolio, I called about 30 of my friends who are business owners or, significant decision makers in companies, and just asked them for their feedback on what they felt was happening, what they felt like was happening in the marketplace, in their businesses. And I talked to truckers and restaurateurs and gas station owners. I talked to hoteliers and accountants, IT guys, all kinds of different people. And about 30% of them said, hey, things are great. My accountant, for example, said his business is good and he feels like most of his clients are doing well. But about 70% of people felt like there were significant changes. One client of mine, a friend of mine from Tucson, told me that his business had been growing pretty dramatically, but this year probably going to be flat. That he felt like his clients were not spending money, were hesitant to do things. He didn't know if it was the election or some greater part of the economy, but he certainly was feeling it. A friend of mine in Flagstaff works in the hotel business, said their revenues were off dramatically. Just story after story after story I heard was, people are tightening their belt, people are getting concerned. And, another thing that's occurred is that in the last few weeks, the Fed has reduced interest rates by 0.5%. That's a pretty dramatic reduction. I know a lot of people think that was related to the election, and it probably was in part, but the Fed didn't have to go 0.5%. They could have gone 0.25%. And the fact that they made that big a change, I think, is indicative of the fact that the Fed sees some softness and some concern. So, again, there's no single thing that has made me think that this market's overpriced. It's really just sort of this mosaic of data points that I get, day in and day out as I'm looking at companies and studying the market and talking to friends and just trying to get a feel for what's going on. So that's sort of, again, that's what I'm trying to get at here, is that I've really thought long and hard for several weeks about this before taking the step and before making this video. It's not just a knee-jerk reaction, and it's not a single data point that's causing me concern. There's two more points that I want to make here, and I don't have a good scientific argument for these. The first one is I don't lose sleep about investing. Even during COVID, when the market was down 30%, I sleep like a baby because I really do feel like I do my homework. I've got a long-term approach. When we own stock in H&R Block, I know that, hey, people are going to do their taxes next year. When I own stock in Snap-on Tools, as I say to my friends, I know that things are going to break and we're going to need tools to fix them. And in the long run, you got to buy new tools. So we're going to do fine. But my gut doesn't feel good about this marketplace. And I don't know how to put a value on that. I don't know how to tell you that that's something you should value. Maybe you shouldn't value it, but I do. And if it wasn't for my gut feeling this way, I probably wouldn't be making this video and I wouldn't be taking this big a change in what I'm doing. But I think you should go with your gut. If you spend as much time thinking about a problem as I do, which is investing your time, your client's money, and you do the kind of research that I do, and your gut just tells you something doesn't sit right, I think there's something to be said for that. The final thing to think about is just the idea that risk aversion. If I take your money today and it goes down 20%, and over the next 12 months, it goes back up 21%, that looks like a 1%, but let's say it goes up 30%. That's a 10% improvement in how we've done. But the stress that's involved in going down 20 and coming back is hard on my investors, because many of them are just starting out with me and they don't have a chance to have had success and have kind of been through this and to develop confidence. It's also really hard for a lot of people to lose money, even if it's only a short-term thing. And in addition to that, if I put off holding your money until the 20% happens, we're never in that hole, and then we get the entire 30% of upside. So the risk aversion component to what I'm trying to do, trying to protect my clients from losses at all costs, even if that costs us some upside, I think is a very valid reason for taking the steps we're taking. So having said all that, what steps am I going to take? First of all, I'm going to go to about 50% cash. It's not actually going to be cash. I'm going to buy government bonds with it so we still get some yield. I'm going to cut out a few positions. I'm going to dramatically reduce a bunch of positions. A few positions are going to stay the same. But basically, we're going to get to the point where we have a lot less exposure to this market. I'm also telling all of my current clients that for the time being, I won't accept new money from them. And I can't, if you want to put money in, that's fine, but I would advise you not to. I'm telling potential new clients, including somebody I just met today, that I am not accepting new money from new clients. We can open an account, put $1,000 in as a placeholder until we're ready, but I think it's just not the right time to be investing money. Now, I hope that you recognize as my investors that that's a pretty strong stance for me to take. My business, I'm trying to grow it. And the only way I grow it is by growing the money under management, the assets under management. And if I'm willing to arrest the assets under management for what might be, months, that should be a sign that I really am very hyper concerned about where we are in the marketplace. Now, should you take money out? If you want to, I can't blame you. And you're watching this video, that might be a good conclusion. I don't think we're going to do too bad in the marketplace with a position of 50% cash, which, by the way, means we'll be earning, income in terms of interest income from the bonds we'll be buying. And I don't think the positions we own are going to get hurt nearly as bad as the market. But if you want to take money out, I don't blame you. And it's your money, and you should feel free to do it. I would prefer if you leave the money in cash, because what's likely to happen is there's likely to be this correction. And when this correction happens, a whole bunch of really good companies are going to get thrown out with the bathwater. And I'm going to want to pounce on those companies. And maybe there's going to be a very short window during which I can do it. And when that's happening, I'm not going to have the time, the inclination to call everybody and say, hey, let's get back in the marketplace. And by the way, it might take a couple of days for you to get your money in, and by then the opportunity is lost. So what I would prefer to do is have you leave your money in the account, but let's not put new money in, and let's see how things go. So having said all that, if anybody wants to call me and talk to me, you've got my number. You can certainly email me. I'm happy to talk individually about what's going on with you and what you might want to do. But that's sort of where I am in the marketplace. Those are the changes I'm going to be making. I've given you the reasons why, and hopefully that makes sense to you, and hopefully you appreciate the conservative approach I'm taking to managing your money.